Okay, I think we can go ahead and start. Thank you everyone for joining us today. I'm Maria Fernandez Vidal. I lead CGAP's work on data, where we've been looking at the role that data can play to help advance financial inclusion. So I'll just share a few logistics before we start. Just want everyone to be aware that the webinar will be recorded and it will be made available on CGAP's websites. And your microphones will be muted. So if you want to ask a question, you can use the chat during the presentation, or you can just raise your hand during the Q&A. So our agenda for today starts with an introduction from our CEO, Sophie Sirten. Then Arisha Salman will present some of the main messages from our recent publication, A Global Landscape of Digital Data Trails of Poor People. And finally, I will be moderating a discussion with Bushle Goslar, the CEO of Jumo, and Jake Kendall, a partner at DFS Lab. So I'll give it over to Sophie now.
Thank you very much, Maria, and welcome everyone. It's a real pleasure for me to open this seminar because the topic we're going to discuss today is, in my view, absolutely important and potentially transformational for financial inclusion, but it also comes with a lot of risk. And therefore, it's really important that we leverage the opportunity in front of us in the right way. It's an opportunity because the fact, as you will hear during the seminar, that so many low-income households and micro firms have digital connections and generate digital data trail is an opportunity that can be leveraged in the context, of course, of new digital transformations that affect the financial sector. Fintechs, digital banks, etc., can use those data to bring new people into the financial system, so to increase financial inclusion, but also to enhance, to develop many more products of different nature and offer them to more people. So we believe, in fact, that we have an opportunity, probably for the first time ever, to see real progress, not just in financial inclusion as in access, in number of accounts, but really in the depth of financial inclusion, in the number of products that people have access to. That opportunity, we feel, can be leveraged. There are countries that are making very significant inroads in this regard, for instance, by developing open finance frameworks that allow more financial sector players to leverage those data trails, create partnerships, etc. But on the other hand, there is a real risk. There is a real risk because, as the team will show, there are very significant digital divides, and therefore divides in the data trails that people across the world generate, whether it is across regions, across different types of countries, or by gender. And therefore, the potential that I just described could also lead instead to further divides. In other words, the digital divide could reinforce the already existing financial divide. And so I think this discussion is extremely important because we have, as players in this field, an opportunity. We can make it happen. We can create a different future for many poor people, but we also have a massive risk. And therefore, progress in a way, financial inclusion going forward has to come hand in hand with progress in connectivity, in digital inclusion, in smartphone ownership, etc. So I will leave you with those thoughts. I think this is going to be an extremely important discussion for us in the sector, a discussion that we really have to leverage to reach the outcomes we have possibly in front of us if we do it right. So thank you for joining us, and I hope we can hear all your thoughts on how to get there. Back to you, Maria, I believe.
Thank you, Sophie. So we will now share some of the findings from our research. While Larisha pulls up the presentation, I'll let you know a little bit of background. If you're interested in the topic, I encourage you to look at the publication because it has a lot more background information and detail than what we have time to share today. But we'll share some of the main messages. The research that we did had two parts, a global analysis of the data trails of poor people. We focus on low and middle income countries, and we did deep dives in India, Indonesia, Kenya, Mexico, and Senegal. And then we did a second part of the research where we focus exclusively on smartphone data trails. We worked with Caribou Digital on that, and we covered Cote d'Ivoire, Ghana, Kenya, Nigeria, and South Africa. So we'll share some of this today and our main findings, and then we'll have a discussion with our panelists. Over to you, Arisha.
Thanks, Maria. So as Maria mentioned, in this segment, we'll be presenting some of the key findings that are emerging from the global landscape study, and the way we've organized it is around the messages that we have extracted from both the global landscape as well as the smartphone study that Maria mentioned. So the first message is that the digitally included poor people are a growing segment that are spread unevenly across regions. And the way we define this segment is people who are adults in low and middle income countries earning under $5.5 a day with ownership or access to a phone. And there's two things to make note of here. One is the poverty line that we've picked, which is the $5.5 per day purchasing power parity adjusted poverty line, which was the last published highest poverty line by the World Bank. And we do realize there are variations amongst countries, but we did want the most comprehensive indicator of poverty. So we picked the highest one, but when we zoom into markets, and you'll be able to see that in the publication, the differences between markets become clearer of what that $5.5 a day translates into in terms of numbers for digital inclusion. And the other thing to highlight here is that we've used ownership or access to a phone as a metric of digital inclusion. We do acknowledge there are other metrics like access to digital IDs, access to G2P payments, internet connectivity, but we did want to look at an all-encompassing indicator. So we've picked access to phones as that. We've estimated that about 1.8 billion poor people in low and middle income markets are digitally included based on that definition, which comprises about 41% of the population in low and middle income countries. And within the 1,800 million, about 200 million people don't really own their own phones. They use borrowed phones, and that segment is primarily constitutes women. Another thing to note here is that not all 1.8 billion people have access to the internet. There are feature phone users amongst that, and about 750 million of those only have access to phones, and 1.05 billion have access to the internet as well. And that really means that the poor are split in terms of digital access amongst those that have no access to a phone, which we've labeled as a level 0, to those that have access to the internet. And as you move from level 0 to level 3, as you move from no access to a shared phone to a basic phone without the internet, and finally to access to the internet, we do see that the richness of data trails significantly increases between level 0 and level 3. We estimate that by 2025, this segment could include over 2 billion people, primarily driven by an increase in phone penetration. And looking at the geographical split, unsurprisingly, India, China, Indonesia, Nigeria, and Bangladesh account for over 73% of the world's digitally included poor, which is not surprising because they also comprise 60% of the world's poor population. And just reading this graph, I know there's a lot going on here, but if we were to read it on the y-axis, we've looked at phone penetration. On the x-axis, we've looked at the percentage of individuals that fall below the poverty line. And comparing, say, China to India, in China, phone penetration numbers are much higher, whereas in India, they're lower, but poverty numbers are higher compared to China. And the size of the bubble represents the digitally included poor population of the country. Now, what does this really mean? So we have all these interesting numbers about how the digitally included poor are increasing, are a growing segment. They're generating more and more data trails. But at CGAP, we're really interested in what that means for financial inclusion. So amongst the DIP, we see that 81% have a national ID. But those numbers start dipping once you move to financial access. So 67% have an account, and then that number further dips as you go on to account usage. So 26% have used deposits, 32% have used digital payments. And therefore, we see that there is a huge opportunity. There are 600 million people who have phones but do not have an account. And bringing them into the formal financial system could reduce financial exclusion by almost 50%. So we're talking about going down from 1.4 billion people who are financially excluded to 800 million, if only the ones that have a digital data trail can be included. So we see there, or we've identified an enormous opportunity to leverage the data that's being generated by financial service providers to offer more and better financial services to more and more poor and vulnerable people. And we will, in the coming months, be presenting or publishing some findings that show that alternative data trails can be used to offer products like credit in a way that's very comparable to traditional credit bureau data. The second message is that while the poor are generating more and more data, there are significant gender differences, with women lagging behind men in both digital access, but also in the generation of data trails. So we've estimated a 16 percentage point gender gap between digital inclusion for poor women and men, with 63% poor women having access to or ownership of a phone, and in comparison to 79% men. And about 192 million women, as a result, would need to be digitally included, and 192 million poor women would need to be digitally included to close that 16% point gender gap. So that's purely in terms of phone access. But the other dimension of this is that it's not just access to phones, but it's also the quality of data trails that are being generated by men and women that differ. So where women lack access to more sophisticated devices like smartphones, and they're more dependent on shared devices, which further limits their footprint. So they're lagging behind men, both in terms of access, but also in terms of the quality of data trails that are being generated. And the next two messages are coming from the smartphone study. So we do see some patterns in the types of data trails that are generated by smartphone users. And this study focuses on 5 markets in sub-Saharan Africa. And we see that while the data trails of smartphone users are varying across markets, there are also differences by gender, legality, and age. More specifically, men tend to be generating a higher data trail, as indicated by data consumption. Urban dwellers tend to be generating a higher percentage of data trails in comparison to rural dwellers. And younger individuals tend to be generating more data trails than their older counterparts. And these trends are pretty consistent with minor exceptions across markets. Now, interestingly, another gender finding is that yes, men are generating more data trails, but they're also spending more time on higher quality networks compared to women. So if you look at Kenya, for example, men spend about 50% men spend their time on 4G networks or are connected to 4G networks in comparison to 40% women. And that trend reverses once you go to lower quality networks, say 3G networks. One of our inferences here is that women spending less time on higher quality networks could indicate that they also have lower quality handsets, which does add up to our initial finding that they are using, their likelihood of using smartphones is lower than men. In terms of app usage, most app data is controlled by Meta, primarily driven by WhatsApp, but also Facebook. So if you look at Cote d'Ivoire and Ghana, there's a high percentage of smartphone users that use WhatsApp and Facebook as well. But the average duration that's spent on both Facebook and WhatsApp tend to be pretty high in both markets. And we do see for financial service providers, there are applications of this. So there are implications as Facebook and WhatsApp could be leveraged for selling insurance, for financial literacy, lending and insurance, but for also financial literacy communication. And we are seeing in a lot of other parts of our research that WhatsApp and Facebook are also increasingly becoming effective social commerce channels. And looking at our final message, and this specifically looks at the sort of data trails that are important for financial service providers. We see that telco data is the most widely available digital data trail from smartphones, and data on savings and loans is fairly limited. So across the 5 markets that we studied, we see that over 90% individuals are using airtime top-ups and are generating this data trail on a regular basis. And this trend is consistent across men and women. So we didn't see differences in percentages of airtime top-ups being generated. However, we do see that as you move from airtime top-ups to other forms of transactions, the numbers dip. So the other pretty common form of data trail is on P2P transactions, but we see very limited data that's being generated from smartphones on loans on savings. So for Kenya, we do see some numbers there, like 42% for loans, 19% for savings, but the numbers are almost negligible for the other markets covered in our study. Most transactional data tends to sit with MNOs and banks. So on the left, you can see transaction data on airtime top-ups, and both in Nigeria and Kenya, it primarily sits with the MNOs. And on the right, we are looking at financial data. It sits with banks in Nigeria, but in Kenya, even data on payments sits with the MNOs. So they're really holding a large amount of the data, and they're the ones who can see this data. So that brings us to the end of these messages. We have some insights and emerging opportunities. I will skip the next 2 slides because I've just presented these findings, but of course we'll be sharing these slides and we have more details in our deck. But I want to conclude this segment by highlighting some of the opportunities that we've identified that warrant action or further research. And we've split these by our audience types. And this is a good segue into the next segment as well, because we do have someone from our financial service providers audience, who's Bushley, and from the funder audience, Jake Kendall, who can speak more about this. But largely, in terms of recommendations on further research, we do think that there is a huge opportunity to continue understanding how the digital footprint of low-income individuals is evolving, specifically the data that's being generated by smartphones, but also how data sharing models like open banking could help FSPs really extract this data and share this data across other players. For financial service providers, we do see a huge opportunity to leverage this data. And as I mentioned earlier, we have done pilots where we have evidence that's emerging that a lot of this data is comparable for applications like credit scoring. And we would encourage FSPs to also go beyond credit scoring and explore other use cases, for example, enhanced KYC processes or overdraft protection. And finally, for funders, there's of course a lot of research based support, but also supporting FSPs that are developing business models that rely on data trails like airtime top-ups and P2P transactions. So that brings us to the end of this segment. I think we have time for about a few questions, and I know there's questions in the chat, so we can address some of those, but if anyone wants to raise a question, we can also take that up if you want to raise your hand and ask a question.
There's a couple of questions in the chat. I think there is a question on how has the pandemic changed this, and there what we can say is the initial analysis we had first done it with data from 2019, and then we redid it when new data came out from after the pandemic. And we did see an increase across most markets in kind of the data trails. The smartphone study was a panel that was collected through a few months through individuals that were willing to participate in the research. So unfortunately, there is no data to go back and kind of check after. But my guess from what we've seen in other things is that the trend is probably the same, and it has increased the usage.
Yeah, and for one market, the data was collected for Ghana right during the pandemic, and once the pandemic was slowing down, and we did see similar trends. So like you pointed, Maria, your guess would be right, and we wouldn't see too many differences in the trends, but of course the absolute numbers would change. We have a question from Alex Rizzi on, I wonder if those data scientists who build models at fintechs are oriented to divides and data trails. So in terms of the specific divides and data trails, I think we, and Maria, you can also jump in on this, we've seen differences in models that account for these differences, and Bushle can speak about what Jumo is doing, because Jumo's model relies entirely on data that's generated on feature phones that doesn't require individuals to have internet access or smartphones. So that sort of doesn't, it controls for the divide in a way, but we specifically for the players that we have worked in, they are, we haven't seen any specific rural solutions, but there are a lot of agri-based solutions, for example, for credit scoring, that do take into account those differences. And we've done a pilot with a few agri-based providers, or a few of those pilots. Juliet has a question on, are there any examples where data trail service KYC, not just credit scoring? The KYC process is probably one of the most. So we haven't really come across the data trail specifically being used as KYC, but we're doing work in Brazil on open finance. And one of the large banks is using open finance data for initial KYC checks. So we do see that it's not just being used for credit scoring, but it could serve in terms, it could serve the data that's shared through models like open banking could be used for larger applications. And that is one of our recommendations for FSPs to explore some of these, some other use cases. For example, overdraft protection and personal finance management. But for KYC itself, yes, we do see some applications coming up in that space. Maria, feel free to jump in at any point. Is there anything else?
I think we've covered the question. Okay, there's a new question.
Something from Abhishek. Do the data trails indicate the user behavior between FSP induced or influenced digital users versus regular users? So if I understand this question correctly, it's on looking at how these data trails are being leveraged by FSPs. Is that right? Maybe Abhishek, you just want to explain that a little, because I'm not sure I'm understanding.
And yeah, I'm not sure if I understand the question, but I don't, if it's about, like, if the question is about the difference between people that became digital to use financial services versus people that became digital for another reason, we wouldn't be able to say, because we don't really know from the data that we have how people started using financial services, started using their phone. So we wouldn't be able to tell the difference between those two types of users. I think it's interesting to see if it would be interesting to see if there's a different behavior, if the users that came on to use financial services then expanded their use to other activities or not. But we don't have a way to kind of tell those groups apart from the data that we have. Okay, I think there are no other questions, so maybe we can get started with the panel, and there'll be some time to ask questions again at the end after the panel, but I want to make sure we have time to hear from Bushle and Jake. So let me introduce them. As Arisa mentioned, Bushle is Jumo's CEO for the Africa region. She also serves on the boards of an e-commerce company, Copia, and the gender equity advocacy platform WIMA. And over the last 2 decades, she has worked in Sub-Saharan Africa, Europe, Asia, in financial services, technology, retail, and tourism. And Jake is a co-founder and partner at DFS Lab. It's an early stage investor supporting companies who are creating the digital commerce infrastructure in Africa. He has been invested in African digital platforms since the launch of M-Pesa, and he has worked both at the World Bank and at the Gates Foundation. So thank you both for joining us today. And I'm going to kick it off with a question for Bushle on what are the opportunities that you see emerging with the increase in these data trails for low-income individuals, but also what are the risks that you may see?
Thanks, Maria. So I think in terms of opportunities, it's really important that we are cognizant of the bigger why that we are doing all of this, right, in terms of inclusion in general. So I think the biggest opportunity is really that when people are able to participate, to be included financially, they will be able to participate economically. So these are people who otherwise would not be able to do that. They'll be able to have a safety net, because that's what a loan is, right? It can be a safety net, it can be cash flow smoothing, and so on. And I think that sometimes we can underestimate the type of stress that exists, right? Like in the study, you talk about under $5 a day. So at a very human level, life is better, right? I think, for the purposes of this audience, I know you're looking for kind of the more technical answer, but I just thought, we should start with that. So obviously we're opening doorways to entirely new customer segments, which is also important. And, we, as you mentioned in the report, have actually been at Jumo involved in providing services to the digitally included poor for the past 5-7 years already, right? So very early on, we realized that there was an opportunity in what was traditionally known as thin file segment. And we actually started building scorecards using GSM data as well, right? And, we've spoken about having originated over $5 billion in loans, and about 40% of that actually is to people, entrepreneurs, agripreneurs, who fit into what you've described as the digitally included poor in your report. So opening doorways, yes, creating a new segment is important. Then I think the other opportunity we can look at here is the lowering of costs overall in terms of access, right? Because by definition, once you start thinking about providing services digitally, especially when it comes to alternative scoring and so on, we're also moving into channels which are much more affordable. So, for some of these people, they might have had to lean on informal lending, and now they will actually be able to access these services at much lower costs, which is really important. Then the third and last one that I'll mention is that there's an opportunity here for financial services overall to evolve, right? So we're going to see new types of chief risk officers in financial services institutions. They will evolve. They will move away from traditional methods of assessing risk, which is basically self-reported and historical and static information, to this more real-time information. We'll see the formation of new kind of complex value networks, right? Because having the data is one thing, but how do you actually get a product into this customer's hands? Often this requires partnerships between different types of entities, right? So you might have a bank, a fintech, potentially even an additional ecosystem owner provider, right? Which can be a mobile network operator, it can be an e-commerce platform and so on, where the customer, which is actually the interface with the customer. So lots of opportunity here, both social, economic, and, great things, but challenges. And I think Sophie alluded to this in her opening, right? So, we're going to need to start to ask ourselves questions. Who can use this data? Who owns it? What about, the kind of derived IP? Can people form data silos? Can people move with their digital footprint? All of these things, which are questions which, in fairness, have been kind of bouncing around, I think, in the sector. But I do think that when you start to include more vulnerable segments who have less of a voice, then it becomes important for regulators and other actors to get involved and ensure that as we're empowering people with these new services, they also have adequate protections, and that we don't create kind of competitive environment disasters, right? So I think those are things we need to think about. And then, of course, there are other things around, which data is used, how is it used, how do we think about the design for privacy as well, recourse, all kinds of things, I think, become more important. But I think all in all, my kind of philosophy when it comes to data is that it must flow. And, in any environment where it's not flowing, what you probably will find is that it's not powering inclusion in the way in which you would have liked. So, that's kind of how I would frame some of the opportunities and challenges that we see emerging.
Thank you very much, Priscilla. Then I'll move over to Jake and ask you a little bit about the funding landscape. So this data to have an impact needs to be used by businesses, right? There need to be data-driven business models that are willing to use this data for inclusion. So I want to see, how do you see that space? What do you think are the business models that are using data that will be growing and attracting funding?
Yeah, so I guess I wouldn't say that there is fully a consensus in the investor community around sort of data-driven credit and other sort of data-driven finance models. Certainly some investors are very excited about data, see it as kind of on the frontier and that kind of thing. I think others are, fine with it, but want to see it in context of more sort of value-added service or built into a platform embedded into a wider context of a relationship with a customer. So in our mind, in terms of how we look at data, there's an important distinction between this kind of uncontextualized data that you can kind of suck out of the ether around individuals, often off their mobile, versus data that's created in the context of a relationship and an ongoing sort of service provider or value-added service relationship that that potentially has maybe more value. So, if you look at like the failure or the pivots of some of the original raw kind of pure alt data lenders, the branches, the Talas, right? I think they're kind of evidence that sort of purely uncontextualized data off a smartphone or some other device wasn't as nearly as useful as previously thought. And there are some, maybe a second generation of companies like that are slightly more sophisticated, looking at, sort of pure play data-driven services. But they're yet to be proven in my mind. I think Jumo is actually one that I would say is kind of an exception on the landscape. They've found a really, solid niche with the mobile operators and the banks. I think there's a couple of issues. So one is, like I said, data, generally these kinds of services need to be, at least, from what we see in our portfolio and others on the landscape now in Africa, they need to be embedded in something that's more valuable and appealing to drive kind of wider scale uptake. And then data on its own, especially in the credit context, usually relatively weak as an origination mechanism without some kind of leverage point to back it up. Now you can do smaller, kind of higher frequency things maybe, but if you want to get a little bit bigger in terms of overall loan size and longer term, and sort of put out larger amounts of capital, generally anyway, it needs to have some sort of leverage point. And leverage point can be, I'm providing you a service and I can stop providing that service if you don't pay me back. A lot of the mobile operators could, they have that as an option. Maybe I'm processing your payments, and if I decide that you haven't paid me back fast enough, I can take some of that money that you're owed from your, merchant payment processing or things like that. So, those are some leverage points. We see a lot of actually, interesting ones and more creative ones than that. But and often I think that data in those contexts is very valuable because you can use it not to sort of understand the individual small business or person who's borrowing from you, to say, hey, this is a left-handed person with red hair and size 15 shoes or whatever, but actually and therefore score them, but actually really to score the relationship. So how much, say they've taken a Pago solar panel from you, they paid it off, and now they want to borrow again. Well, you can score with your data how much that Pago machine, panel is worth to them, right? Do they use it twice a month, to maybe recharge a phone, or are they using it every single day to do homework, to light a business, whatever it is? And so that's kind of thing where we think there's real power in the data to score, in particular, that the sort of like the value of the leverage point. If you can, shut off that panel and take it away from them as an option in their household. I think, so I think for us, that's driven us to the conclusion that there probably are a few sort of standalone pure data-driven models, but that mostly that's not a gigantic opportunity space, and that the data often then becomes important, but is more of a business model extension or enables some kind of a margin enhancing service that is, like I said, contextualized within some other digital platform or digital commerce play or something else, basically. So that's kind of how we see it. And like I said, I wouldn't necessarily say that that's a consensus across all investors. I do think that there's a variety of opinions still on kind of where the value of data is.
So a strong focus on kind of the context in which that data is generated. Let me ask Bushle, because like you said, Jumo is an example of a data-driven business model. So I wanted to ask you, we showed a little bit of transactional data and airtime top-ups in the research. I know this is the type of data that Jumo uses. So could you tell us a little bit more about how you use it, what it means for your business?
Yeah, sure. Thanks, Maria. I think really great insights from Jake. I couldn't agree more. You know, data on its own is definitely not a formula for success. So I think, you know, often when people ask this question, what they're really asking is, can you use alternative data sources like this in order to establish whether people are creditworthy? So the short answer to that is that at Jumo, I believe that we have proven that that is possible, right? So in the time that we've been operational since 2015, we have gotten the cost of risk down to under 5% across all of our markets, right? And that in a context where, as I shared earlier, about 40% of the people receiving the 5 billion plus in loans that we've originated on the platform are digitally included poor. So in essence, we've proven that you can create highly predictable assets within this segment, right? So yes, it works. And I should also mention that, you know, peer-to-peer transactions, airtime top-ups are some of the data points that we use. We use far more than that. The next question, I guess, that people are really asking when they say that is, but how, right? Does it work? So in our case, technically, the way that it works is that we have a data platform that we call Unify. It's purpose-built, right? And we've built it so that it can really efficiently create yield, or what I call predictable assets, which is how the banks would understand it, or in layman's terms, you know, make sure that people repay their loans. Right, that's it. So that's the platform. It ingests the data from our ecosystem partners, predominantly mobile network operators. We've enabled it to do real-time and batch scoring. Why does that matter? As you pointed out in your report, smartphone penetration is still relatively low. Some people are on feature phones. We know some of the infrastructure challenges in Africa. We want to make sure that our customers have access to the platform at all times. So we've built for both. We have modules in there that deal with fraud and gaming. The platform itself is just constantly learning and evolving. It plugs into our IP library. And what we're managing is not just the origination of the loan, but also what happens when a customer is in loan. So all of that uses data as well, the frequency with which customers get reminders, what messages they get while they're in loan, repayments, and so on, right? So that's how it works. But to Jake's point, which I think is a really important one, why is the business model successful? If we just had Unify, I don't think that we would have seen the type of traction and success that we've seen as a business, right? But in fact, the Unify platform works with two other platforms in Jumo, right? So it works with a platform that we call Core, which is effectively the alternative banking platform, right? Which is really important because it means we can onboard banks, we can take care of all kinds of things like sanction screening and so on, right? And then there's a third platform that we call Magneto, which is actually an asset management engine. What this does is it allows us to take capital in every market from multiple capital providers, right? These can be banks or institutional funders, all of who have different performance requirements. Why does this matter? Because the digitally included poor that you've described, they may not be within the risk appetite of every single funder, right? And so we've actually built a platform that allows us to pull capital, social impact capital, retail bank capital, and in real time, when we're originating the loan, we assess the risk, we see where a person sits, and we decide where that capital is going to come from in line with that funder's required performance mandate. So that is how we've been able to make it work. And I think that's from a business model perspective. From a consumer perspective, it works because the way in which the customer experiences it is so simple. I've described what probably sounds very complex, but if you're the consumer, it's so easy. You just go to the place where you always go. So if it's your mobile network you go there and you access it in a very simple customer journey. It all happens in real time. And you know that you have the reliability and you see yourself progressing and being rewarded for your good behavior. So it's really a very positive experience. You have customer service in a place that you're used to with your mobile network operator. And that's why it works. So the why definitely goes beyond just the data. So I really loved what Jake said, because, you know, certainly what we're experiencing in the field is that there are many different things that you need to wrap around that data to make it work in a way that is, you know, both empowering and safe for consumers.
Thank
Will,
you.
can I ask you a question as your fellow panel mate here? So I mentioned Branch and Tala, which, you know, I don't know what your sensitivity is to speaking about them, but you know, I see as largely have their, at least their initial foray into sort of this unstructured data lending to have failed, and they have, you know, both kind of pivoted in quite different directions. I wonder, I'd be very interested to hear, you know, quickly, so I guess sort of your explanation of how you guys are different and how you avoided that same fate, because you clearly have.
Yeah, so I'd actually attribute a lot of this really to Andrew, the Juma founder's vision for the platform in the first place, because to be honest, we ended up here kicking and screaming initially, not all agreeing. And I think, you know, one of the challenges that he set out for us right from the beginning was, let's just not be here if this isn't huge, like if we're not able to reach the maximum number of people. And so kind of the constraints that were drawn right from the beginning were made it so that we had to shape a solution that was quite different to what everybody else was doing at the time, including the challenge, which by the way proved to be really true, that if you want to grow something that is so huge in emerging markets, your business model needs to include some of the key actors, and that and in this case, in financial services, that includes the banks, right? And I would say that was really prescient. We see that now. We've benefited hugely from having our banking partners on board. They've pushed us in the way in which we've developed the platform from a risk and compliance perspective, right, to develop features which have allowed us to effectively get the platform verified and credentialized. If we hadn't brought them on, although it was initially really difficult, we wouldn't have done that. You know, the kind of those constraints also pushed us to think about capital differently. So we were forced right from the beginning to innovate across a number of verticals. We had to think about the capital, right? You know, if you're thinking of originating billions, which in Africa is a lot, right? You've got to think beyond retail banks. With the product, we had to think, well, because at the time, smartphone adoption was nothing like what you're describing in the report. So we had to think, okay, this has to work on a feature phone. And because a lot of our investors are impact investors, we had to think about customer protection. And I saw Alex is here, so she knows my pain from those days, because we worked with the Smart campaign to go, how are we going to do this? So there was that product innovation, and of course the data innovation, which we've spoken about, and you know, you've interviewed us as well at CGAP around that. So those constraints that were created for us helped us evolve in that way. And I must be honest, in those early days, we often would look really longingly at some of the other players who seemed to be, you know, creating things that were far cooler, while we had to solve really fundamental issues like regulatory and capital. And those things didn't seem super exciting at the time, but as it turned out, those things have been fundamental to our ability to scale now. And now we're getting to do more exciting things like, you know, what we're doing in merchant lending. You know, there's just a lot more that we can build on now. But that's kind of the history that led us there.
Yeah, I have to say that what you were describing with, I think you were calling it your Magneto platform, you know, the liability side of your balance sheet, and the sophistication you guys are bringing to that. That's quite interesting. I haven't seen that from anybody else, and it's often kind of ignored or not catered to as a real. You know, you have to recognize that the banks and the capital providers are your clients as well, right? So
hugely, and in fact, the other big insight into that is often people talk about how do you lower the cost of loans to people. And it's often kind of just a stick that people would want to beat the financial services provider with. But in reality, you have to think about sources of capital. So in what you were describing with some of the early iterations of the app lenders, it is no surprise that their pricing was so high, because they were either using equity to fund the loans, or either way it was dollar denominated funding, right? And the part of the reason why this constraint was created by Andrew for us from the beginning was that if you want to lower the price, then you have to get local funding, right? And when you get local funding, then you can lower the price. So I think that was something which was missed in those early days. And of course, once you lower the price, scaling becomes really easy.
I want to ask you both from your different perspectives, just from Jumo's specific experience and Jake from your view as an investor. What are the challenges that still remain? What is constraining growth in the space? If you want to reach more customers, offer bigger loans, go to more markets, what are the challenges and the barriers that are still there that we would need to work on?
well,
So
go ahead, Billy, if you want to go first.
cool. So I think the general trends are really positive, right, in terms of the availability of data. I think from where I sit, the things that are still a little bit difficult are sales cycles, right? So when we think about, you know, how do you build these partnerships and things which allow you to use this data and you know, go to market, that's still a challenge. And I think it's kind of, you can see that it's a challenge from the number of times whenever there are tech forums, there's always a panel on how do we do partnerships better, right? So I think that's important at kind of a micro level. At a macro level, regulation, I think is important. I think one of the things that we constantly need to keep in mind is that for operators to invest in a market, regulatory certainty is important. You know, we spoke about how data, you can't just use data on its own. For you to use that data, you need to know that you'll be able to use cloud computing. So if you have, you know, potential data localization requirements and things like that, that makes it really difficult for you to be willing to invest, right? So I think that's really important. And then I think also linked to regulation, which one needs to think about, especially in Africa, where the markets are fragmented, is creating kind of more unified regulation to make markets more addressable for operators, because of course, you know, you don't want to be customizing your platform for, you know, 54 different requirements. And I think here a great example that we're seeing emerging is in the Waema region, so Francophone West Africa, where, you know, they're having kind of a singular approach to these issues, which is now making that region far more addressable for operators.
Jake?
Yeah, I mean, you know, all stuff I agree with. I think when I heard that question, I took it almost from more of a, you know, what are the challenges as either an investor or a donor in this space, and as opposed to bullies, I think bringing the operators challenges. But from my perspective, I think it goes back to what I said before. There's not that many business models that, as standalone data-driven business models, make sense. I think, you know, Jumo's been able to carve out a niche because they basically hit one of the biggest data pools out there, mobile operators plus banks, right? And you know, maybe one or two challengers in that space could find a niche, but there's not very many other data pools that are big enough to really justify an entire standalone business model. And maybe, you know, that's a little bit the flip side of what I was saying, the data on some level needs to be embedded. It's embedded in a particular context. And you could see someone who's got a great product in that context, but then it's hard to scale beyond the context, right? If it's very context specific. So that, you know, that I think is a challenge in terms of purely data, sort of pure play data models as an investor. I think from a donor having actually, you know, worked at Gates and been in the donor side of the table, I think that makes it challenging for a different reason, which is that as a donor, you kind of want to fund things that are demonstration cases that are going to stand out and say, oh, this is a great model. We can now go replicate it all over the place. I mean, it's almost the opposite incentives of investors. We want to invest in things, and then we don't want anyone to be able to replicate them. We want to go do it ourselves. You know, we want our companies to go do it. Whereas a donor, you want it kind of to be free for the world. But in either case, it just becomes hard to replicate into other contexts. Another area that we see is that some informality can sometimes disrupt the patterns you get from data. So, and that's, you know, that can be a challenge again from the donor's perspective, where, you know, the informal side of the economy is probably the part you want things to, you know, you want to support the most, and that's where you want any of the solutions that you create to work, right? And where that plays out in kind of our investment portfolio and some of the companies we're tracking is, you know, these FMCG platforms, for example, the B2B ones that are restocking small businesses. So they see this huge amount of like staff turnover at the retail establishment, and that can change very dramatically sort of how the data is being entered, whether it's being entered at all, whether, you know, app is being used in a particular way, et cetera. So even small things like that can really kind of challenge the data that you get out of a particular relationship or app or you know, context, basically. And then maybe one final observation, I guess, is that, you know, we see a lot of, I think it's kind of the standard norm, maybe, the providers using data to make the user look more attractive to them or improve their profitability as a user, but we see it a lot less often being used to improve the value to the user itself. And so if it does, you know, if it's not being used to improve like the value that the user gets, you know, lowering the price or improving the performance of the product, you know, then the uptake doesn't really change, just kind of improves the profitability a little bit. So I think there's, you know, be very interesting to dig into more sort of where are those use cases, you know, income smoothing or things that sort of that alter the product sort of more fundamentally to create value for the user as opposed to just lower cost for the provider.
Thank you. We're over time, but I want to give 1 minute to Bushlet to answer a question, because you briefly touched on your experience working with the SMART campaign. There's a question on Jumo's approach to data privacy and consumer protection in the context of a lot of customers that are new to financial services, new to digital. So maybe you can share a little bit more on that work you did.
Yeah, sure. So I think it must have been about 2016, 2017. We actually worked, this was before the development of the digital standards. We worked with the SMART campaign to do what was effectively a didactic assessment of our business model against the SMART principles as they applied to MFIs at the time. And so they generated a report for us on various areas that we could look at and improve on. We worked through that in our social and ethics committee, board subcommittee. And then what we did was we actually, it must have been 2016 actually, we then developed what we called our customer operating principles at the time. And these were things that really kind of described the impact we wanted the platform to have, right? We wanted to drive access and inclusion. We wanted to make sure that we were generating financial value for customers, choice and empowerment. Our orientation was around creating sustainable digital ecosystems. We set out principles around data stewardship and what was required for that. And that was something which everyone had to sign on to, including data scientists. We did a bunch of training, and Kamya, who has been our head of customer success, she now has an expanded role. Her and her team run these campaigns across the business every year, and everyone does their new attestation. It's something which is now very much a part of what we do. And yeah, so that's, you know, some of the collaborations that we did with Smart at the time, and a few other things. But I think that was kind of the pivotal point for us in our journey in kind of deciding how we would balance empowerment and protection as an organization.
Thank you very much. That's very interesting. So I want to thank you both for your time and sharing your insights with us. And thank you everyone else who joined and participated in the webinar.
Thanks for having
Thank you.
us.
Thank you. Bye-bye.